Most people waste their first 5 investing years. You finally did it. You opened a brokerage account. Maybe you were 23, maybe you were 31, maybe you were somewhere in between, but you finally got past that mental barrier that kept you from starting. You transferred some money in, probably not a lot, maybe a few $100s, and you felt this weird mix of excitement and terror. Like you just had been handed the keys to something important, but nobody gave you the manual. So you started researching, hours on Reddit, YouTube videos about stocks, articles about ETFs, podcasts where people throw around terms like dividend yield and expense ratio. And somewhere in all that information overload, you made your first investment. It felt significant, like you were finally becoming a real adult who does real adult things with money. 5 years later, you look at your account and realize you basically spun your wheels. Maybe you made a little money, maybe you lost some, maybe you broke even. But when you really think about the time you spent, the hours of research, the anxiety over market dips, the constant checking of stock prices, you realize you could have just put everything in an index fund on day one and been in almost the exact same place. Probably better off with about 1% of the stress. My name is Jack, and I spend way too much time thinking about investing psychology, market behavior, and why people's first years of investing are almost always a masterclass in doing everything the hard way. And here's what keeps me fascinated. It's not that people are stupid or lazy. It's that the entire investing world is designed to make you feel like simple strategies aren't enough. Like you need to be constantly active, constantly researching, constantly optimizing. And that mindset, that belief that investing requires constant engagement, is exactly what wastes those first 5 years for most people. What you're about to hear isn't about complicated strategies or secret techniques that Wall Street doesn't want you to know. This is about understanding why your instincts as a new investor are probably leading you in the exact wrong direction, and how the people who actually build wealth treat investing completely differently than you think. Because the gap between how beginners invest and how wealthy people invest is huge. And honestly, it's not what most people expect. The paralysis of infinite choices. Let's start with what happens to most people on day one. You've got money sitting in your brokerage account and you need to decide what to buy. And this is where things immediately go sideways. There are thousands of stocks you could buy, hundreds of ETFs, bonds, REITs, international funds, sector-specific funds, growth stocks, value stocks, dividend aristocrats. The options are basically infinite. And because you're new to this, you don't have a framework for making decisions yet. So you do what any reasonable person does. You start researching. You read that Apple is a great company, but then you read that it's overvalued. But then you read another article saying that people have been saying it's overvalued for 10 years and it keeps going up. You look at Tesla and half the internet says it's the future and the other half says it's a bubble. You discover dividend investing and it sounds amazing. Passive income. But then someone says dividend stocks underperform growth stocks. You learn about index funds and they sound boring. You learn about options trading and it sounds terrifying. And here's what happens. You freeze. Or worse, you do the thing where you spread your money across like 15 different investments because you can't decide which one is right. So you try to do a little bit of everything. You end up with 2 shares of Apple, 1 share of Microsoft, 3 shares of some dividend stock you read about, and $50 in an ETF that tracks small cap companies because someone on Reddit said it was undervalued. This is the first mistake. Not because those are bad investments necessarily, but because you've created a portfolio that's too complicated to understand or manage, and you did it based on information overload rather than any coherent strategy. You basically walked into a massive library and grabbed 15 random books instead of reading one good one cover to cover. The wealthy investors I know, people who've actually built multi-million-dollar portfolios, almost always started simpler than you'd think. One index fund, that's it. They put money in VTI or VOO or some total market fund, and then they just kept putting money in for years. While everyone else was trying to beat the market, they were becoming the market, and the returns speak for themselves. The tinkering problem. Okay, so let's say you make it past the initial paralysis. You've got some investments. Now comes year 2, and this is where the real waste begins. You start noticing things. One of your stocks is down 8%, another one is up 15%. You read an article about how the tech sector is overvalued. You hear about some new trend in renewable energy, and you think, maybe I should rebalance. Maybe I should sell the winners and buy more of the losers. Or wait, maybe I should sell the losers before they drop more and put it all in the winners. Or maybe I should completely rethink my strategy because you just discovered a new investing philosophy that makes way more sense than whatever you were doing before. This is what I call the tinkering problem. You can't leave it alone. And it's not entirely your fault. The investing industry basically trains you to do this. Every financial news site has a new headline every day about what you should be buying or selling. Every podcast has a new hot take on market conditions. Your brokerage app sends you notifications about your portfolio performance. It's all designed to keep you engaged, because engaged users make more trades, and trades generate fees and revenue. But here's the brutal truth. Every time you tinker with your portfolio based on recent performance or news you read, you're probably making your returns worse. There's actual research on this. The average investor underperforms the market by about 1.5% to 3% annually, and the main reason is behavior. Buying high when things feel exciting, selling low when things feel scary, jumping between strategies instead of sticking with one. I knew this guy, let's call him Marcus, who started investing around the same time I did. He was so into it. He had spreadsheets tracking his performance, he was in multiple investing Discord groups, he spent hours every week researching companies, and he was constantly adjusting his portfolio, selling this to buy that, rebalancing based on market news. He probably made 100 trades in his first 3 years. Meanwhile, I basically put money into VTI every month and forgot about it. I checked my account maybe once a quarter. I was honestly kind of embarrassed by how little effort I was putting in compared to Marcus. 5 years later, we compared returns. I beat him by almost 15 percentage points cumulatively. Not because I'm smarter or because I knew something he didn't, but because I did less. I let compound growth work without interrupting it. Marcus interrupted it constantly, and every interruption had a cost. Taxes on gains, missed opportunities, buying at the wrong time, selling at the wrong time. The lesson isn't that research is bad or that you should never adjust your portfolio. It's that activity and returns are not correlated the way beginners think they are. Often they're inversely correlated. The more you do, the worse you perform. Chasing performance like it's a sprint. Here's another thing that destroys those first 5 years. Performance chasing, and oh man, this one gets everyone. You see that some fund or stock or sector had incredible returns last year, like 40% gains or something wild, and you think, if I put money in that now, I'll get those same returns going forward. So you buy in, feeling smart and strategic. Except here's what actually happens. The thing that did amazing last year usually doesn't do amazing this year. Sometimes it crashes. Sometimes it just goes sideways. Because markets are cyclical and nothing stays hot forever. But you bought at the peak after everyone else already made their money and now you're holding the bag. This happens with individual stocks, with sectors, with investing styles, with everything. Tech stocks crush it for 3 years, everyone piles in, then they stagnate or drop. Value stocks lag for a decade, everyone abandons them, then they have a great year and suddenly everyone's a value investor again. It's this constant cycle of people showing up late to the party and wondering why there's no more food. And the thing is, you know this is happening. Like, intellectually, everyone knows buy low, sell high. But emotionally, when you see something rocketing up, your brain screams, get in before you miss it. And when you see something dropping, your brain screams, get out before it gets worse. Your instincts are backwards. They're designed for immediate survival, not long-term wealth building. I wasted probably 2 years of my early investing doing this. I bought a semiconductor ETF after it had already climbed 35%, because I read that chips were the future. It promptly dropped 20% and took 3 years to recover. I sold some dividend stocks during a market dip because I got scared, and they recovered 2 months later. Every time I chased performance or reacted to volatility, I shot myself in the foot. The investors who actually build wealth do the opposite. They buy things when nobody wants them. They hold through volatility. They ignore the noise. Warren Buffett's famous line is, be fearful when others are greedy and greedy when others are fearful. And that sounds simple, but it's psychologically brutal to actually execute. It means buying when it feels scary and holding when it feels like you should do something. The education trap. Now let's talk about something that sounds productive but often isn't: excessive education. You spend your first year reading books about investing, The Intelligent Investor, a random walk down Wall Street, maybe some Peter Lynch. You watch hours of YouTube videos, you follow investing Twitter. You're consuming content constantly, and it feels like you're getting smarter, more prepared, better equipped to make good decisions. But here's the trap. At some point, more education becomes procrastination. You're learning instead of doing. You're preparing instead of executing. And in investing, time in the market beats timing the market almost every single time. Those years you spend getting ready to invest seriously are years you're not benefiting from compound growth. I see this especially with people who get really into the technical stuff. They learn about options strategies, about spreads and collars and iron condors. They study technical analysis with candlestick patterns and moving averages. They dive deep into financial statements and learn how to calculate enterprise value and free cash flow. And all of that knowledge is interesting, sure. Some of it might even be useful. But the question is, useful for what? If you're trying to become a professional investor managing other people's money, then yeah, maybe you need that depth of knowledge. But if you're just trying to build wealth for yourself, you probably don't. You can build a seven-figure portfolio over 30 years without ever looking at a balance sheet or knowing what EBITDA means. There's this concept in learning called the 80-20 rule. 20% of knowledge gives you 80% of results. In investing, that 20% is stupidly simple. Buy broad index funds regularly, minimize fees, don't sell during crashes, let compound growth work over decades. That's it. That's the whole game for most people. Everything else is the other 80% of knowledge that might improve your returns by a few percentage points if you're really good at it, or might make them worse if you're not. The first 5 years are when people typically go deep into that 80% of knowledge, thinking they need to master all of it. Meanwhile, the people who just focused on the 20%, the basics, executed consistently, are already years ahead in actual wealth accumulation. The fee bleeding nobody notices. Let's talk about something that seems small but absolutely destroys wealth over time. Fees. When you're new to investing, a 1% management fee doesn't sound like much. Or commission fees of $5 per trade. Or expense ratios of 0.75%. These are tiny numbers, barely noticeable. And that's the problem. They're small enough that you ignore them, but over time they compound into massive amounts of lost wealth. Here's the math that shocked me when I first really understood it. If you invest $10,000 and it grows at 8% annually for 30 years, you'll end up with about $100,600. But if you're paying 1% in fees, so your net return is 7%, you end up with $76,100. That 1% fee cost you almost $25,000, which is more than twice your initial investment. 1% doesn't sound like much, but compounded over decades, it's devastating. And in those first 5 years, people are constantly making fee mistakes. They buy actively managed mutual funds with 1% expense ratios because they don't understand that index funds with 0.03% expense ratios usually perform better. They use financial advisors who charge 1.5% of assets under management without realizing they could get the same or better advice for a flat fee. They trade frequently in taxable accounts and get hit with short-term capital gains taxes that eat into their returns. Every unnecessary fee is wealth transferred from your future self to someone else. And the insidious thing is that you never see the wealth you lost. It's invisible. You can't mourn money you never had. But it's real, and it's significant. The best thing I ever did for my investing returns was switching from actively managed funds to index funds and becoming obsessive about minimizing fees. My expense ratio went from about 0.80% blended to under 0.05%. That difference alone is worth tens of thousands of dollars over my investing lifetime, and I didn't have to do anything except make one decision and then stick with it. The tax optimization. Nobody teaches you. Here's something that almost nobody figures out in their first 5 years. Tax efficiency matters way more than you think. Most new investors don't even think about taxes. They just buy and sell whenever they want, in whatever account they have. They don't understand the difference between tax-advantaged accounts and taxable accounts. They don't know about tax loss harvesting or the difference between long-term and short-term capital gains. And these mistakes cost them thousands. Let me give you a concrete example. Let's say you buy a stock in a taxable account. It goes up 30% in 6 months, and you sell it because you're excited about the gains. Awesome, right? Except now you owe short-term capital gains tax on that profit, which is taxed at your ordinary income rate. If you're in the 24% tax bracket, almost a third of your gains disappear immediately. If you just held it for another 6 months, it would have been taxed at the long-term capital gains rate, which is probably 15% for you. You just gave the government an extra 9% of your profits for no reason except impatience. Or here's another one. People max out their Roth IRA and then put additional money in a taxable brokerage account without maxing out their 401k first. That's backwards. The 401k reduces your taxable income now, which saves you money on taxes this year, and the money grows tax-deferred until retirement. For most people in decent tax brackets, maxing the 401k before doing taxable investing is a no-brainer. But it's not intuitive if nobody explains it to you. I didn't think about any of this stuff for my first few years. I was just excited to be investing. I had money scattered across different account types with no real strategy. I sold stocks without considering tax implications. I probably paid thousands more in taxes than I needed to because I didn't understand the rules. Now I'm pretty meticulous about it. Dividends and interest-generating investments go in tax-advantaged accounts. Growth investments can go in taxable accounts. I harvest tax losses when appropriate. I hold investments longer than a year to get long-term capital gains treatment. None of this is complicated once you understand it, but it makes a real difference in how much wealth you actually keep. What you should actually do. So after laying out all the ways people waste their first 5 years, what's the alternative? What should you actually do? First, radical simplicity. Start with one total market index fund, something like VTY or VTSAX. That's it. Don't add more until you really understand why you're adding it. Most people should probably just stick with that one fund forever and be perfectly fine. Second, automate everything. Set up automatic transfers from your checking account to your investment account. Set up automatic purchases of your index fund. Remove the decision-making from the process. You're not disciplined enough to manually invest every month. Nobody is. Automation solves that. Third, maximize tax-advantaged accounts before doing anything in taxable accounts. 401k up to the match, then max out your Roth IRA, then go back and max out your 401k, then if you still have money, start a taxable brokerage account. This order matters. Get the tax benefits first. Fourth, minimize fees obsessively. If an expense ratio is above 0.20%, you should have a really good reason for paying it. Most of the time you don't. Switch to cheaper funds. Use low-cost brokerages. Never pay trading commissions if you can avoid it. Fifth, and this is the hardest one, stop looking at your account. Check it once a quarter, maximum. Definitely don't check it during market crashes. The more you look, the more you'll be tempted to tinker, and tinkering costs you money. Set it up right and then mostly ignore it. And finally, understand that investing is boring. It should be boring. If it's exciting, you're probably doing it wrong. The people who build real wealth through investing are the ones who make it a background process, not a hobby. They spend their time and energy on things that actually matter, their careers, their businesses, their relationships, and they let their investments quietly grow in the background. The compound growth you're missing. Here's the thing that really drives home why wasting those first 5 years matters so much. Compound growth is exponential, and the early years are disproportionately important. If you invest $500 a month starting at age 25 and earn 8% annually, by age 65, you'll have about $1.75 million. If you wait until age 30 to start, you'll have about $1.13 million. Those 5 years cost you $620,000. You can never get that back. You could invest $1,000 a month from age 30 onward and still not catch up to what you'd have if you just invested $500 from age 25. This is why wasting your first 5 years by spinning your wheels, paying high fees, making emotional decisions, and constantly tinkering is so costly. It's not just about the money you could have made in those 5 years. It's about the compound growth that money would have generated over the next 30 or 40 years. Every dollar you invest in your 20s is worth way more than every dollar you invest in your 40s, even though they're the same dollar because of time. Time is the secret ingredient. And when you waste time, when you spend years figuring out what you should have known on day one, you're throwing away the most valuable thing you have.